Welcome to the deep dive. Today we're taking a calculated jump into one of the most unpredictable corners of the market, the biotechnology sector.
High stakes is putting it mildly.
Right, so we ran a really targeted stock screener, filtering for stocks over $10 with genuinely significant trading volume. And that search gave us 3 tickers that just perfectly illustrate the high-risk, high-reward game here.
That's right. So our mission today is to really pull apart the essential investment nuggets for you. We're combining the hard fundamental metrics, the technical trends, and of course, the latest news flow.
For our top 3, Olema Pharmaceuticals, ARVN and Moderna.
Exactly. The goal here is to give you a full journalistic report on what is actually driving these stocks.
We really need to analyze what the data is telling us, not just what the headlines are shouting. Now, before we get into these extreme price moves, we have to just underline one thing.
Disclaimer, yes.
We're talking about publicly available data. We're simulating scenarios here purely for educational purposes, for market observation. This is not investment advice. It should not be considered that.
And please remember, financial markets, and especially biotech, carry just inherent and, frankly, extreme risks, understanding that volatility is the first step.
And that brings us perfectly to our first company, which is basically volatility in its purest form.
It really is.
Let's unpack this. A genuine study in explosive momentum. Olema Pharmaceuticals, ticker OLMA. So just looking at the basic data, OLMA is a small to mid-cap biotech. Market cap of about $1.38 billion, closed recently at $20.14.
But that's not the story.
Not at all. The real headline here is the sheer velocity of this thing. On the day we screened this data, the stock saw a massive daily change of plus 136%.
On astounding volume, too. 86.5 million shares traded. You just don't see numbers like that. I mean, not unless there's a major clinical breakthrough. This isn't a gradual buildup. This is an instantaneous, extreme breakout.
And what's fascinating is how the technical metrics, they confirm that momentum, but they also flash these bright red warnings.
Oh, they're screaming. The technical picture is absolutely screaming. If you look at the relative strength index, the RSI,
which measures if a stock is overbought or oversold.
Right. Olema's RSI came in at 87.52.
87. Anything over 70 is considered overbought.
Exactly. So 87 is the market shouting, "This cannot continue." It suggests a huge risk of a violent snapback, a correction, no matter how good the news was.
And the beta of 2.08 just confirms it's historically twice as volatile as the market.
And the performance numbers just back all this up. I mean, look at the week. Up almost 146%, the quarter. Up almost 270%.
It's sitting 600% above its 52-week low.
Yeah, that daily jump created a massive price gap, too, 211%. And for a technical trader, that gap, well, that's a magnet. It's something you watch because prices often come back down to fill those gaps.
So what was the catalyst? What triggered all this?
The sources are pointing to positive test results from Roche. That news apparently sent the stock skyrocketing right around November 18th. This is the lifeblood of a clinical stage biotech. It's the proof of concept.
And what did Olema do the second they hit that peak valuation?
They announced a public stock offering.
Of course they did.
It's the classic biotech dilemma, isn't it? It's a smart move for them. You raise capital when your valuation is highest to fund all that expensive R&D.
But for the investor who just rode that wave up,
it can dilute their shares. Or at the very least, it puts a cap on the immediate upside. The whole question shifts from how high can this go to, okay, how long is their runway now?
Fundamentally, this is just a pure speculative play. I mean, their reported sales are zero, no revenue.
So metrics like price to sales are totally meaningless. It's a company built entirely on a promise.
But their balance sheet has a key strength.
It does, and this is crucial for a company like this. Their quick ratio is excellent at 8.03, and their debt is almost non-existent. This is their safety mechanism.
So they have plenty of cash to cover their liabilities.
Exactly. It secures their R&D timeline for the foreseeable future, even though, as you'd expect, all the profitability metrics are deep in the red.
So let's run the paper money math here, just to feel the impact of that 136% jump. Imagine an investor got in at the previous close of $8.52.
Okay, with a hypothetical $5,000 investment.
Right.
At that price, you would have picked up about 586 shares.
And with that dramatic close at $20.14, the paper value of that investment is now $11,802.
That's a paper profit of over $6,800.
A 136% return in a single day. It just perfectly illustrates the explosive reward and the huge technical risk of clinical news hitting a small biotech. Okay, so after that raw speculative power of OLMA, let's pivot to Arvinus, ticker ARVN. This is a very different story. This is more the clinical comeback.
Right, a different risk profile entirely. It's got a market cap of about $834 million, closed at $12.99. It also had a strong day, up over 17% on really high relative volume, so lots of interest there.
Arvinus is interesting because of its specialization, right? The PROTAC protein degraders.
Yes, and for anyone learning, this is really next-generation drug discovery. Instead of just blocking a problem protein, their technology tags and destroys the disease-causing proteins entirely.
So it's a completely different mechanism.
Completely, and that technological edge is why the market is betting on them again, even after some past failures.
And you can see that optimism in the recent momentum. Up over 80% for the quarter, 95% for the half year, the uptrend seems confirmed.
But, like with OLMA, the technicals are flashing some caution signs. The RSI is high at 75. Not as extreme as 87, but it's definitely a yellow flag for a short-term correction.
And the short float is pretty high too, 13.69%.
Yeah, that's a significant chunk of the market betting against ARVN, which, sets up the potential for a really volatile short squeeze if more good news comes out.
Here's an interesting conflict in the data, though. The analyst target price is $12.31. That's actually below the current closing price. So what's going on there? Is that just caution from the analysts, or are they just slow to update their models after this recent run-up?
I'd lean toward caution, and their history gives us some context for that. The news highlights a major prior event, a dramatic 53% stock plummet back in March of 25.
That was from the mixed results for a big breast cancer drug tied to Pfizer.
Exactly, and that led to a wave of analyst downgrades, a real loss of confidence.
But the recent news has been a story of pipeline recovery.
A very successful one. Q3 results showed a loss, but they topped revenue estimates, which the street loved. And critically, they announced the FDA accepted their new drug application for vepdegestrant.
That's a huge de-risking event.
Massive. They've also shown positive preclinical data for a bunch of other degraders, including some for Parkinson's.
And this is a company that, unlike OLMA, actually has sales.
Right, about $312 million in sales, gives it a price to sales of 2.67, and they have an incredible gross margin of 98%.
Wow.
So their core manufacturing is super efficient, even if the R&D costs keep their overall operating margin negative.
But the real safety net for ARVN, I think, is their cash position. Cash per share is at $12.26.
And the stock is trading at $12.99, so an overwhelming majority of the current stock price is just backed by cash on the books.
So you could argue you're only paying about 70 cents for the entire future pipeline.
You could, but the question is that cash a true safety cushion, or is it just the required fuel for R&D? Given the sector, the market sees it as a major risk mitigator. It lowers the fundamental risk quite a bit.
Let's visualize that recovery with our paper money sim. This time, let's say a paper investor bought the dip after that big drop, maybe somewhere near the 52-week low, say $7 a share.
Okay, $5,000 in at $7 a share gets you roughly 714 shares.
And at the recent $12.99 closings, that paper investment is now worth $9,275.
A paper profit of over $4,000. An 85% return from the lows. It's a perfect illustration of a rebound play. Shows that strong clinical data can just rapidly override past failures.
Okay, so we've seen the speculative surge of OLMA, the clinical recovery of ARVN, and now we have to turn to a very different beast. The well-known large-cap player, Moderna, ticker MRNA.
An S&P 500 member, massive market cap, $9.74 billion, and its daily move was, a mild plus 0.65%. Its beta is low. It's just a totally different animal.
And its story right now is a case study in, well, a corporate transition failure.
That's a good way to put it. They're trying to pivot from being the world's pandemic vaccine producer back to a diversified R&D giant. And the financials, they just lay bare how deep that challenge is.
Sales are down 56% year over year. That reflects the collapse in COVID vaccine demand.
And the profitability crisis is just stark. I mean, they're deep in the red. Negative income of over $3 billion and a profit margin of negative 139%.
Let's pause on that. A negative 139% margin.
It means for every dollar of sales they're bringing in right now, they are losing almost $1.40.
Wow.
That level of loss just confirms they are burning through a vast amount of capital, desperately trying to prove their mRNA platform can succeed in other areas.
And yet, despite all this pain, the future outlook from projections isn't entirely bleak. The EPS next 5-year projection is positive, at over 20%.
Which suggests the market is pricing in a future, maybe 4 or 5 years from now, where one of their other candidates finally hits.
But the technical picture reflects the current reality, and the reality is pain.
Oh, absolutely. The metrics are negative across the board. Down over 5% for the week, a punishing 40% year-to-date. The stock is trading below all the key moving averages. It's a solid, sustained downtrend.
And it's basically sitting on its 52-week low.
It is. And that weakness is driven by news. While the Q3 earnings beat revenue estimates, that was mainly through cost cutting. The major setback was the news in October that their CMV vaccine,
Once seen as the next blockbuster.
right, it failed a key study.
That's a pipeline killer. When a company is relying on a few key candidates to justify its valuation, the failure of one of them can wipe out years of gains, which is what we saw.
It is. But despite all this, the analyst consensus is surprisingly mixed. The target price is a very generous $39.06.
And that's the Moderna paradox, isn't it? Why maintain such a high target when the current fundamentals are so dire?
That high target represents long-term faith in the platform, in the core mRNA technology itself, not the current results. Institutions are basically playing a waiting game, betting the tech will eventually deliver a successor to the COVID vaccine.
Let's run the final paper math, focusing on that painful decline. This shows the cost of betting on a large cap when the pipeline doesn't deliver. So if an investor had bought near the 52-week high, say $48.92.
Okay, $5,000 would have gotten you about 100 new shares.
And now at the recent close of $24.92, the paper value of that is only $2,541.
That's a paper loss of nearly $2,500.
A loss of almost 50%. That's the brutal risk you take betting on multi-billion-dollar innovation when it just fails to hit those critical milestones. So this deep dive gives us 3 perfect contrasting snapshots. You have OLMA with its hyper momentum on a single breakthrough, backed by low debt.
You have ARVN, recovering from its past with unique tech, supported by a huge cash reserve.
And then you have mRNA, the established giant, just struggling with revenue transition and major pipeline failures.
The synthesis here for you, the learner, is really clear. In biotech, technical momentum and news can completely override negative fundamentals in the short term, especially for smaller companies like OLMA.
Meanwhile, for giants like mRNA, one critical failure can erase billions, despite a powerful underlying technology.
The key takeaway is that in biotech, you are paying not for what a company is doing, but for what it might do.
And here's where it gets really interesting, tying back to that Moderna paradox. Given that Moderna has massive institutional ownership, 70%, yet its performance is lagging so badly, how much of that $39 analyst target price is based on financial reality?
Versus how much is just pure optimism for future unproven drugs.
Exactly. That gap between the current price and that big projection, that's a serious tension and something you should really explore on your own.
Always question if the target price reflects earnings or just enthusiasm.
Precisely. Until next time, stay curious.